Welcome to the NEREJ and NYREJ podcast. I'm your host, Rick Kaplan. My guest today is Michael Chase. He's the managing director of the Boston Regional Office for Northmarq, and he's also the past president of the New England CCIM Chapter. Good morning, Michael.
Good morning, Rick. Thank you for having me.
It's always a pleasure to speak with you.
Likewise.
And, well, we'll find out how much of a pleasure when we talk about the finances right now, because everything is just very confusing right now for a lot of people. And a lot of guys are trying to make deals, and they need the money. So what's going on with all the money right now is the Fed, it goes up, it goes down, are we going to see it flatten out a little, or is it going to stay up and down for a little while? What's going on?
Well, there's a lot to unpack there, Rick. You mentioned the Fed, so we'll start there. Last week, of course, the Fed made their most recent announcement, and they decelerated their pace of rate increases. They only went up 25 basis points. The market reacted in a particular way. Short-term rates reacted positively to that. I think a lot of investors and borrowers were excited to see that the pace of increase was starting to slow, that the Fed was feeling confident enough in its battle against inflation that they were willing to slow that down. Of course, 2 days later, we had a knockout jobs report, and rates went back up in reaction to that. And part of that is because the Fed is only one part of the picture, right? There's what they're doing, and that has particular weight and influence over the short-term rates, that 1 to 3 to maybe up to 5 years. But then economic outlook is really what drives the longer end of the yield curve, the 10-year treasury, the 20-year treasury, 30-year treasury. And while the Fed keeps moving up, the short-term rates, long-term rates, they have been down because of fear of recession, but some of those recent economic indicators are showing that maybe the Fed's going to actually be able to manage a soft landing, and economic outlooks are looking kind of positive. So then the 10-year treasury went up. It had gotten down to a low of 3.35 last week after the Fed's announcement, but then on Friday, it's now back up to 3.6. So the other thing to keep in mind, though, when it comes to interest rates and the Fed, is it's only part of the story. There's the underlying index that your loan might get priced over, but then there's the spread component. And the good news for borrowers is, even though those treasuries were a bit volatile last week and ended the week up, corporate bond spreads have compressed. And the good news is, so that allows mortgage spreads to compress and offset some of those treasury rates. So I think going back to your underlying question, what about just availability of capital and financing? There is capital available. It's a brand new year, fresh allocations from many capital sources, including life companies and banks, particularly the middle market banks and credit unions. And so they're out there and they're looking for the right deals. Underwriting standards have gotten a little tighter. That's true, but there's still plenty of capital out there. And I think if you're a borrower who is particularly interested in long-term financing, this is still an attractive time. The 10-year treasury, as I mentioned, has been bumping around 3.5, is now about 3.6. Corporate bond spreads have been compressing, over the last couple of months. So long-term interest rates are attractive and not likely to get much better going forward. But if you're a short-term borrower, a construction loan borrower, looking for bridge financing for that value-added turnaround play, that's really where the market is particularly tight right now.
Yeah, I talk to a lot of developers, a lot of property owners, and they're some of them are treading lightly right now. Not sure what they should do. Some are kind of hoarding some of their funds until they figure out what's going on, and some are still going full force.
Right.
Who knows which one is the right way to do? No one knows what that right direction is, but what would you say is the right direction?
Well,
Suggest, I should say, what would your suggestion?
right. Well, I think the most common answer in commercial real estate, Rick, right? It depends, and it depends on your business plan and your position. So I do think that there are a lot of people, particularly here in the Northeast and in the Boston market, you can't fully, if you're a developer, you can't put the brakes on fully. The entitlement process, the approval process is such a long lead time that you can't just immediately, take time off and go to the sidelines and completely stop, because it would take so much time to get restarted. Now, can people maybe slow the pace down or try to manage their schedule a little bit more? And maybe you slow down, but you don't necessarily stop. Um, and then, of course, there's what you may be finding challenges in one area, but then finding benefits in another, right? So, towards the end of the year, yes, rates have been elevated, but costs were starting to come in. So you started having materials and supply costs coming in, even though rates were up. Um, as rates might be coming back down, there might be more activity starting, people getting back into the market, looking to get their projects restarted. Well, that's going to create more demand, and then your materials costs go up. So which is the worst? Is it the rate or the materials cost? What I would say in terms of rate, again, we're certainly seeing elevated short-term interest rates, and that remains to be the case today. However, if you are still in the market and you're looking at building, we are seeing a return of swaps for banks lending on construction. And we're seeing an interesting dynamic now where borrowers are doing some deals and banks are offering them quotes where there may be an elevated floating rate during construction, but they're doing a forward swap and the long-term fixed rate is already set and it's lower than the construction rate. So you're kind of minimizing your risk on the back end. And, so there's some opportunities to look at there.
That's very interesting what you said, because, I've heard some construction companies, they have pre-ordered for projects that are not going on right at this time, but they'll be going on in a year. But they'll already have a lot of the materials in a warehouse somewhere because of that shortage. So they want to try to be proactive on that.
Right.
So that's going to tie up a lot of funds.
Sure. And that's not only a hedge for cost, that's just simple making sure you have what you need in the time that you need it. We're still solving supply chain issues, and there are still, certain components, such as elevator shaft items that are still have long lead times, maybe 12-month lead times in order to get. And mechanicals, again, to run your elevator. And it's not just a matter of hedging the cost. You just want to make sure you have the part when you need it, when you're ready to install it, so that you can get your building done.
Well, I mean, this is great for guys that have a supply uh, type of businesses, distribution. They probably have been stocking up for a little while now for this exact problem. And they're probably, because they have to pre-order the stuff and keep it in a warehouse. I mean, that's going to drive costs up, because I'm sure they're not going to sell that stuff cheap, especially if they're storing it for a year. So, I mean, I think we're going to see the supply chain costs go up in the next year or two. And maybe the supply chain of materials will be readily available, but now you're going to pay more.
Right. I
You
think what
know,
you're describing is a shift from kind of the prior just-in-time supply chain and inventory method to now just in case. And it's certainly a benefit to the industrial warehouse investors and developers out there that there is the need to source some of these things. And of course, again, putting in these pre-orders and making sure you have the components is so vitally important, because you not only want to make sure you got your name or your order in line, but you never know what force majeure might happen. All of a sudden Florida has a hurricane, and there all of a sudden becomes a big need and a draw of those materials and products heading to those areas of need. And you want to make sure that you have your order in and fulfilled, and hopefully it is resting somewhere ready and waiting for you to utilize it before you might have your order in. If it's not fulfilled, someone else, FEMA might come in and take priority and fulfill their orders ahead of you.
The scenery around the East Coast, you said the Northeast is fine, but I've been in Florida for about a month, and things are booming there and just getting bigger and bigger. It's almost like everything is full force. No one is thinking that anything's going to stop, which I think gives other people the feeling that things are okay. But are they really okay?
Well, Florida is interesting. Again, I'm not an expert in the Florida market. I am here based in Boston. We do have some clients who transact down there. From what I read, Florida is, of course, an interesting market because they're benefiting from demographic shifts. People enjoying, looking for those states where they have tax advantages, looking for the nice climate and the weather. So you certainly have inbound migration from a lot of other parts of the country, particularly the Northeast, still heading down to Florida. And when you have, that demographic, inbound demographic helping to support your economy, the challenge for Florida is, of course, is the insurance market. If you are along the coast, which is where most people I think want to be when they're in Florida,
Right.
you're seeing, can you get that wind and flood insurance coverage? And that, if anything, that would be the one kind of headwind to that market down there, whether it be residential or commercial.
Get at is that the financing, if you have that kind of tragedy and you have a tragic hurricane or something like that, and the insurance companies can't pay out, what happens to the the bank or the loan that they have on that property?
Mm.
It,
Yes, it's an interesting question. I mean, certainly this is a reason why I'll talk to the commercial side. I'm not an expert on the residential side, so I'll stick to my lane, which is commercial. And most commercial lenders, they're not going to let you just get any kind of fly by night insurance provider. It's not as like auto insurance where you can get anything from just the bare minimum coverage, which might not pay out, may or may not pay out, to actually having legitimate coverage. In commercial, when they're evaluating your coverage for closing, they're generally looking for you to have AM Best rated, A rated companies providing your insurance. So I think the risk for those groups defaulting and not providing the insurance is minimized in that respect. For owners and investors, more about the cost and finding the coverage, right? Finding that provider that is well rated and willing to provide the coverage at a reasonable cost, that's the biggest issue for property owners right now, is making their numbers work when they're seeing these increased costs. For certain asset classes, such as industrial or retail, you may be able to pass those costs through to the tenants. But of course, that impacts their overall cost of occupancy, which then could impact your potential for rent growth in the future. For other property types, such as multifamily or office, pardon me, that was my computer. For other asset classes, such as multifamily or office, the landlord may be needing to pick up that cost and may not be able to pass it through as readily. So then that's going to obviously impact their overall yields. But then you mentioned, what happens if it doesn't pay? Of course, I think the landlord is motivated to try to get a property back to its income producing potential. But if not, that's why you have things, either a non-recourse loan without personal guarantees. If the insurance just doesn't pay and you don't have the ability to financially restore the property, you hand the keys over to the lender. If you are providing a personal guarantee, then that lender may look to go after that.
well, that whole thing is very interesting, especially when I think about the Seaport District. And they've had their issues with the flooding and all that. And this year, and I think last year, they had a lot of accidents. During the work sites. All of those things. I is it making it difficult for a lender to want to fund projects in that area?
I think what you're talking about certainly about sustainability issues, right? And there have been a lot of measures taken, particularly in areas of the seaport, such as moving mechanicals out from the basement and making sure that they're up on an upper level, so that as potential, water levels rise, or if there are, weather related incidents, that a property will be able to, weather that storm. So I think lenders are being more and more cautious about where properties are located and the sustainability characteristics of those buildings. And I think going forward, you're going to see more and more of a focus on that. Sure.
Now, there's also funding for new projects right now. Are you getting quite a bit of request for funding for new projects, or is it just where's the funding being? Uh, who's asking for funding right now? Is it for new projects or existing projects, or
Sure.
just you know?
Great question, Rick. So, where transactions are occurring and where financing requests are coming from are from a couple of different areas. One, there are still developers who are seeking development financing to get their projects going or completed. There are projects which might be, partially complete and they need their capital to finish off the deal. Um, there are transactions where maybe they had a floating rate financing previously and they had a rate hedge, and those rate caps are expiring, and then they need to recapitalize that deal because perhaps they're not finding a favorable rate cap market as they're coming up against that maturity. Um, there are loans which, of course, are just maturing. So there are refinance requests. There are investment vehicles such as equity funds that have certain time horizons, whether that be 5 or 7 year time horizons, and they need to start to dispose of assets in order to return capital to their investors. So you have those potential transactions and needs for capital there as well.
Well, you presented that better than I presented the question, because you gave me the exact answer I was looking for. So you're a good mind reader. The whole industry is getting a little crazy. I mean, I mean, just look at what they have developed in the past 10 years. Um, I mean, it's just unbelievable. And like I said, I was just in the southern Florida market, and that has just been incredibly developed, you know. But I look at what we're doing here in Boston, East Boston, which is our next step for being redeveloped in the Revere area, in Lynn. I mean, those are areas that were really suppressed kind of for many many years,
Mm,
and now it's just like who can buy up the land faster, to redevelop it.
right.
When you get into an area like that, and I got to give the South Shore a little, south of Boston a little love too, because Brockton is also starting to redevelop certain areas, which these are areas that have gone really bad in the past 30 years, which they were always very nice cities and towns, and then just started to fall apart and become like almost slums. Now
Mm.
it's turning the other way. Uh, do you have a lot of people that are looking to develop in these areas? Uh,
Sure. Well, I think capital seeks opportunities. right? And if you're looking in Cambridge or Somerville and you're looking to invest in those markets and you're seeing, 4% cap rates at the peak of the market, sub 4% cap rates in some cases, and you're saying, man, these prices really seem elevated. Where can I get more bang for my buck? Well, do I go outside of 495? Do I go to an area like Fitchburg, where maybe I am able to buy for a 7 or 8 cap? But if I do that, what kind of rent growth might I get? Or do I look at some of these other close in suburban areas, either close in markets or close in suburbs, which, as you mentioned, may have been overlooked for one reason or another. But there may be some untapped potential there. So you're right. That 1A corridor heading up north. I mean, you're looking at rents in Cambridge and Somerville and in Melrose and in Malden, and you realize, gee, why are rents in Revere and in Chelsea and in Lynn, a fraction of those? And where is the opportunity there? And you've seen developers who are able to successfully go into those areas, work with the communities and work with the local government to make very successful projects in those areas. And of course, once you get that ball rolling, then more capital comes in to follow, and an area can really turn around. So of course, right, downtown Brockton is seeing investment because there is opportunity there. There is certainly a margin for your investment capital if it's invested, correctly and appropriately.
Now, some of these areas, they have the so-called opportunity zones.
Mm-hmm.
Is that something that you're able to help them with financing as well? Because I know they have certain grants and things like that, though.
Sure. So opportunity zones have been around for quite some time now. Um, and we're actually getting up to a point where some of the benefits are starting to expire or go beyond. So opportunity zones are still out there. They're still a vehicle for non-real estate investors who have capital gains and from non-real estate investments such as mutual funds or other assets, and they want to defer their tax liability. 1031 exchanges were taken away from everybody but real estate owners, so they can use the opportunity zone vehicle to defer some of those gains for a while. Yes, opportunity zones can create possibility to enhance a deal. They don't really make or break a deal. You shouldn't get into a deal simply because it's an opportunity zone investment. They can make a deal a little better, but they don't make a deal stand on its own. So you need to certainly be careful about opportunity zones, opportunity zone investment, opportunity zone funds, to make sure that the deal really does make sense on its own merits. And then, there's some potential tax advantages with that. So when it comes to lenders, I think, which is really where your question was, there really aren't a lot of capital providers who do special programs that are related to opportunity zones. What you do have is you have banks who benefit from what are called CRA credits, Community Reinvestment Acts. And it just so happens that a lot of the properties which may, be in opportunity zones are also in low income census tracts. So they may qualify for CRA credits for certain banks if they get involved in those deals. Also, you have, if it's a multifamily opportunity, you do have Fannie Mae and Freddie Mac, who their mission-driven goals is, of course, to support affordability. So they're going to be very interested in deals that fit within their mission-driven goals. And again, many of those may overlap with opportunity zone investments. So again, it's not a specifically tied to opportunity zones, but it's something where if you happen to have a project, it makes sense on its own merits, it's within an opportunity zone, maybe you can qualify it to attract some equity that you might otherwise not have gotten. And maybe you find another loan program that's catering for one reason or another. Again, a bank with CRA credits or agency lenders looking to support affordability.
So that brings up another question. What equity partners do you like to see when you're looking at a loan? Are there any particular?
Well, the common response, Rick, for lenders is they like to lend to borrowers who don't need the money.
Well, of course.
So, yeah, I mean, it comes down to financial strength and experience, right? You want to have someone who has experience in the type of project that they're putting forth. You know, if it's a group that's historically been retail developers and now they're bringing forth a hotel development, you might ask the question, well, where is the hospitality experience coming from? And then, of course, it comes to the financial strength and not only net worth, but liquidity, especially in this market, in this time in the market, where you do have cost management concerns. You want to make sure that, all right, this is a group, this is an equity group that's got the depth and breadth to be able to make it through. If they do see a rise in costs, whether it be supplies or labor or delays on the project, that they're going to be able to make it through and not have to come back and say, well, cost just went up 20%. We need more debt. Are they going to be able to contribute that to make sure the project gets done?
So you're saying if it's a retail developer and they want to put in a hotel, uh, they need to have that experience in place in their operation for you to look at that financing.
Ideally, yes. I mean, you're looking at both their financial strength and also their experience, and you're looking at the overall team. And if it's not sitting in the equity provider, there are times where people they have the funds but not the experience, but then they can supplement that by building a good team, right? They have the right third party property management group. They have the right general contractor who knows and has experience in building hospitality assets. So if the experience is not contained within the primary sponsor or equity provider, then you go outside of that and go, okay, well, have they built themselves the proper team?
Yeah, because nowadays you see a lot of that going on where you get the shopping center with the multifamily and maybe even a hotel. I mean,
Right.
uh, what is it? Patriot Place, perfect example of it.
Mm-hmm.
Then you have, a lot of these other WS development, which builds quite a few of those type of developments.
Right. And
Uh,
oftentimes what you'll see is they may have a specialty. They may have a specialty in retail. So they'll assemble a site, they'll do the retail component, and then maybe they'll do a pad site or a ground lease to an office developer, or they'll do a ground lease, or they'll sell a parcel to the multifamily developer, or they'll sell the parcel or do a long-term ground lease to the hotel developer. So they can add that all those mixed use components, so that everything is there and everything is in harmony with each other, and they can all benefit from being around each other. But they may recognize, okay, if they don't have that expertise internally, or if they don't want to develop it or hire it, they may can still diversify their site and improve it, but use other ways, again through long-term ground leases, or decide to sell the parcel. But they're going to control who buys the parcel, who has that ground lease, so that it does sync well with the rest of their vision.
Michael, I've known you a long time. We do quite a few things together, and I know you are like a fortune teller. You'll be able to tell me what the future is with all the financing for 2023. So, what do you think is going this whole confusion of the rates going up and down and all of that? Where do you think we are heading by the end of 2023? And what do you think the person, the borrower, uh, if they should feel comfortable enough to even want to jump into these murky waters somewhat?
Well, here, let me check my crystal ball. uh
And I know you
Cannot
have one.
foretell now. So, uh of course, no one knows for 100% certainty what's going to happen going forward. Um, I think what we need to keep in mind is that the real estate market is has a lot of different segments, as well as the finance and capital markets. So you really can't put a blanket statement over the entire real estate market, just like you can't put a blanket statement over the entire capital markets, right? You may have times when industrial is faring very well, while office is a challenge. You may have times where long-term investment makes sense, but short-term is a challenge. Institutional deals are going gangbusters, but the middle market or smaller deals are facing challenges. So there are so many different segments, whether it be location, asset class, duration, and size, that can go into a transaction or an opportunity, and you have to evaluate it all. And there are pros and cons and strengths and weaknesses to all of it. So one, of course, the biggest takeaway is when there are challenges, there are also opportunities. So whenever you have a challenging market or marketplace like we have now, you're going out there and you're trying to seek what are those opportunities. Um, Again, as I kind of alluded to earlier, when it comes to capital markets right now, if you are a short-term borrower or need a short-term capital, such as construction, bridge, or short-term permanent financing, 1 to 3 year, yes, you may be looking to say, okay, well, when will the Fed start to reduce rates? When will those might be starting to come down? Do I slow down or do I put a pause on things until I wait for that more attractive rate environment? However, if you are a long-term investor, if you are a family fund, or you're someone who's thinking 10 years, 20-year hold, now is the time to act. Again, you have the 10-year treasury still in the mid threes. And the long-term goal for the Fed is to, in the current period, get rates up to a restrictive level so that they can battle inflation. So they're going to get up to that five, maybe break five, maybe not break five, whatever it may be. They're going to get up to a level that they feel is enough to manage the inflation issue. And then they want to, over time, ratchet that back down so that going forward on a long-term basis, they're at a nominal rate around 2%. Okay, so as that short-term rate comes back down to 2%, what will happen to the 10-year treasury? Are we really going to be going back to 0% interest rates? Hopefully not, because that means there's a major disruption or a catastrophic event. And I don't think we're seeing that right now. So unless you believe that you're going back to 0% interest rates because of one of those issues, then you have to think, okay, the long-term goal is a 2% federal funds rate. So that's going to mean the 10-year treasury isn't going to be falling all that much more than the mid threes it's at now. So if you're a long-term investor, now is an attractive time to get your deal done. Also, if you happen to have been unable to refinance your property over the last couple of years because you were locked in with a make-whole prepayment provision, such as yield maintenance or defeasance or swap breakage, and you have a year or two still left on your loan, you do have the benefit of elevated short-term rates that could allow you to have a more favorable prepayment penalty, or even a benefit if you're doing swap breakage, and then allow you to roll into what should still be considered a favorable long-term interest rate. It might not be as attractive as what you could have gotten a couple of years ago, but it could certainly be better than what will be available in a couple of years from now.
Last thing,
Sure.
most and I think this is because I've talked to a lot of these commercial real estate property owners. It's a lot different than if we went back to like 2008 or even other parts of centuries ago, in when the cycles changed. Commercial real estate developers and property owners, more of the property owners, have lived through a lot of those cycles, and I think are planned and are ready to adapt to them.
I agree.
More so now than in prior cycles.
I agree, Rick. The commercial real estate market is very efficient in determining winners and losers, right? Things will work its way through. So, if someone got out over their skis too far, the market will come up with capital, either to take them out of the deal or help them get through the deal. But and there are funds that are being raised right now. Opportunity funds, rescue capital that are looking to take advantage of some of these opportunities, which may be coming up in the short term. I would say, though, that there was probably a 10-year period there where we had that, just long expansion. You had a lot of people coming into the commercial real estate market who had never seen a downturn, right? And, 2020, 2021 was their first that they had seen in over 10 years. So there are still some people with a little bit more gray hair who can remember what it's like to have a cyclical real estate environment, and can appreciate that the real estate market is cyclical and can plan accordingly. And there are others who are maybe hoping for those, times when, again, 0% interest rates, that wasn't a sustainable interest rate environment, a capital markets environment, a real estate market environment. You don't necessarily want it to go back to that. So I don't think you want to plan for it to go back to that.
Well, the good thing is the guys that have been around for so many years and know how to manage that cycle. When they see the guy in trouble, they're like the sharks. They see that blood and they go after him and they gobble him up. Which is somewhat I see some of that starting to happen, to be honest with you.
Especially within certain segments of the market, as we talked about, office certainly is going to have some challenges. So you have capital being raised to try to take advantage. Anytime you have an outlook for a potential down cycle, you have people who raise capital, get things ready to take advantage of opportunities as they arise. The interesting thing is there's a very narrow lane of opportunity there, right? Where if there is a downturn, some of those opportunities actually materialize and people are able to take advantage of them. You need a moderate downturn for that to happen. If a downturn becomes widespread, like we had in the GFC back in 08, 09, or like we had in COVID in 2020, if you have just a widespread systematic issue, well, then everybody gets forgiving, right? The regulators get forgiving, the lenders get forgiving, the foreclosure courts, they don't want to be overwhelmed with everything happening all at once, so they get forgiving. And these things never truly materialize because everybody gets to kick the can down the road, right? So if you do have a downturn, it's got to be moderate for people to not have to come up with system-wide solutions, and then for some of these opportunities to materialize and people to be able to benefit from that.
Well, I think we put out a lot of information. You put out a lot of information. And I think it was great information. And I do appreciate you telling us what the future is going to bring.
Well, this interview was free, so the advice you get, is you get what you pay for, right?
Well, at my prices, that was very good advice. But the whole world is crazy right now, and there's not much we can do about it. So, it's business as usual. I say, we went through that whole pandemic thing, and everyone didn't know where we were going to end up with that. We came out of that, and looks like we're almost right back to where we were before that. I mean, hopefully
Yeah, I
that.
mean, exactly. When you think about 2020 and the pandemic, it impacted retail, it impacted hospitality, but industrial went gangbusters, multifamily went gangbusters, right? So those segments of the market did very well those years. Now we're beyond that. We're in a different climate, right? Retail is back. Grocery anchored, unanchored strip, those, maybe there's still some softness in your power centers or your large shopping malls, but there are certainly some areas of strength in retail. Hospitality is doing very well right now. Again, hospitality, the rates of return and everything, the metrics have gotten to a point where the capital was coming back, and now they're looking at those opportunities. They're seeing an attractive market, so they're coming back to it. So it's office that still has some challenges that they're going to navigate through. But you also have a lot of really big players in that space with a lot of capital behind them. So they'll figure it out, whether it be repositioning some of those assets or, again, managing it through and deciding, again, who the winners and losers are. Market is cyclical. It'll work its way out.
Yeah, and you're absolutely right, because most of those markets that you mentioned, they bounce back like nothing ever happened, and except for the office. And I I did hear, I think it was on one of the worldwide news stations, that office space, a lot of these companies that had the space are starting to call back a lot of their employees. They want them to come back into the office because they were finding a disconnect. So that whole office thing might change the dynamics again, you know?
Sure. And the question is, how much will they have to come back? Right?
Right.
Will we ever return to the full 5-day work week? That's a question. They may say, hey, you need to come back to the office because we need that collaboration. We need that sense of community. We need to be able to instill a corporate culture. But can we do that on 3 days a week? Or can we have it with shifting staffs? So that's an interesting question too when it comes to space utilization, right? Unless you're going to be designing a space with hoteling and people kind of sharing desks, then maybe you can shrink your footprint. But there are also plenty of companies out there who realize, okay, we might be letting people have a hybrid work environment, and maybe they're spending, they're only coming to the office 2 to 3 days a week, but we know there's at least 1 or 2 days a week where we really want the entire staff to be there. And if you want the entire staff to be there, you've got to have a place to put them all.
Right.
So you can't necessarily shrink your space if there are certain days when you need your entire staff to be able to work together. So again, it'll be interesting to see how all of that plays out. What that really impacts, though, that the hybrid work environment, is the ground level retail that's associated with these office buildings in the downtown area, right? Those little luncheonettes, right? I mean, they make all of their revenue within a 90-minute period, Monday to Friday, and now they're having to survive, Tuesday, Wednesday, Thursday.
Right.
And that's why you're seeing still a lot of those, ground level retails in the downtown area still struggling to come back.
Although you're in the downtown area, is where
Mm-hmm.
your office is. And if you walk out onto the streets in downtown Boston right now, it's wall to wall people again. So those little dinettes and I think this going to be able to survive now. It's the ones that really didn't have they lost that whole time we were in lockdown, that they couldn't survive that.
I would agree with you, Rick. Particularly in certain areas of the city, the Back Bay is doing very well. The Seaport is doing very well. I think the financial district is still lagging a little bit. And I think if you're standing on a corner on, again, Tuesday, Wednesday, Thursday, it's vibrant, it looks full. But if you're there on a Friday, it may not seem as full. And if you're there on a Monday, maybe a little bit more than Friday, but it's certainly not to the same capacity and volume as you are, midweek.
Well, I appreciate all your information, Michael, as always. And you know, if anyone wants to get a hold of you, they can go to the northmark.com Boston. Is that correct?
That's correct.
And or they can watch the whole video of this. And at the end will be all your information,
Great.
or the way to get a hold of Michael. And it's also going to be airing on Amazon Music for the podcast, Apple Podcast, Spotify, and on YouTube, and the New England Real Estate Journal website, and the New York Real Estate Journal website.
Great. Yes,
And
please feel free to look me up on our website, also on LinkedIn, and I'm sure Rick will have all my links. So if there's ever anything that I can do to be of assistance to you, if you have any questions on capital markets, or I'm always interested in just meeting people in commercial real estate. So please feel free to reach out.
I can attest to that. Michael is a good guy for everyone to know. Thank you, Michael. We're
Thank you,
talking with
Rick.
Michael Chase. He's the managing director of the Boston Regional Office for Northmarq, and he's also our past president of the CCIM New England chapter. I think I said that back. New England CCIM chapter. Again, I want to thank everyone for listening, and I want to thank you, Michael.
Thank you, Rick. I appreciate the opportunity.